Welcome! In this tutorial, we'll cover SpeedAlyzer's Pro Forma page. The Pro Forma page allows you to input growth assumptions and projections to forecast how the property is expected to perform during the hold period. We'll also walk through a refinancing scenario and show you how SpeedAlyzer automatically handles any working capital requirements. This section is essential for developing a comprehensive financial model that estimates future cash flows, expenses, and income, ultimately leading you to a data-driven offer price. By adjusting these inputs, you can simulate different scenarios and assess the potential return on investment for the property. These projections can be completed in as little as a few minutes, and we'll share some tips along the way. As always, all of your inputs and changes are automatically saved in real time, so you can stay focused on the numbers. Let's quickly jump back to the Deal Inputs page before starting Step 2. Make sure you've completed all Step 1 inputs first before continuing. A link to our Step 1 tutorial is included in the video description below. Before we begin Step 2, let's first establish some investment return targets and set a baseline offer price number using the valuation dashboard on the Deal Inputs page. Don't worry, this offer price is just a placeholder and can be fine-tuned later. Entering it now will help us ballpark the exit cap rate in a later step. Let's start by setting our minimum goals under the Set Minimum Goals section. Here, we will enter our targets for internal rate of return, IRR of 15%, average annual return, AR of 18%, equity multiple of 1.9x, and a debt service coverage ratio, DSCR of 1.2. If you need help determining appropriate benchmarks, watch our video titled Step 3, Valuation Dashboard, linked in the description below. The monitor is color-coded. Red means off target, yellow means approaching target, and green means on target. You will find this real-time monitor throughout the analyzer. Our goal during this analysis is to get all indicators in the green. Next, let's come up with a preliminary offer price. Start by establishing a market-based entry cap rate from recent comps, and enter that rate in the valuation dashboard under the capitalization method. If you need some help finding market cap rates for your asset type and class, use the AI Assist tool. Just click the AI button to generate and copy an AI prompt to your clipboard, and then click the ChatGPT icon to paste your prompt into ChatGPT. You can use the generated response as a guideline or do your own research. Once you've decided on a cap rate, say 5.76%, enter it as your desired cap rate, then click the Value Using Cap Rate button. SpeedAlyzer will automatically calculate a preliminary offer price based on that entry cap rate. Again, this offer price is just to get us started. We'll refine it later as the rest of your assumptions take shape. Across the top, we have our returns ticker. Let's check the box to activate it. This ticker appears throughout the analyzer and provides real-time feedback on our goal metrics as we input our assumptions. We are now ready to move to Step 2 and input our projections. You can access the Pro Forma page from the Deal Inputs page by clicking the Quick Projections button for Step 2, or by clicking the Pro Forma button in the ribbon menu from any page. Let's get started. SpeedAlyzer has 3 analysis modes: high speed, AI Assist, and deep modes. You can use them individually or in any combination, depending on how detailed you want to get and how quickly you need to analyze a property. For this tutorial, we'll be using high speed mode, and we'll point out any AI Assist or deep mode tools as we go. And don't worry, these modes will become self-explanatory as you see them in action. Since SpeedAlyzer can handle both self-storage and multi-family deals, we'll review the differences and share some tips along the way. For the sake of time, I've entered some starting numbers for a fictional multi-family property. Let's jump in at the top with our growth and exit assumptions and fine-tune the numbers. Our first input is the annual rental income growth rate. This is the average rate at which we anticipate rental income to grow from year to year, beginning in the second year of operation. For this analysis, I'll input 2.5%. Next is the other income growth rate, which, like the rental income growth percentage, starts in our second year of operation. I'll input 2.5% here as well. These growth rates directly impact the gross potential rent and other income rows in the cash flow summary below. An AI Assist tool is available to help you research both income growth rate inputs. A tutorial for using this approach can be found on our iHeartCRE YouTube channel linked in the description below. Let's take a quick look at how it works. To access AI Assist, click the AI Assist button here or in the ribbon menu. With a few inputs, this tool generates custom AI prompts. These prompts can be pasted into your favorite AI app, such as ChatGPT, Gemini, or Copilot, which will return recommended projection values along with explanations for each. You can then use these values to fill in the relevant fields in SpeedAlyzer. AI Assist offers a quick and convenient way to generate projections with minimal effort, saving you time. Below the income growth rates, you'll see an expense growth rate average calculation. If you prefer to enter your own rates, you can do that in deep mode using the Expense Builder tool. More on that later. To stay quick and efficient, we will simply calculate an average based on the expense ratio projections below. Currently, the average sits at 2.8% and will change as we adjust our inputs. Next, let's establish our holding period by selecting the year we plan to sell the property. The maximum is 10 years. From the drop-down menu, let's select year 7 for our exit year. The cash flow summary table below will adjust to show only the years in your holding period. In this case, 7 years. A sale year badge will appear in the cash flow summary to indicate the year of sale. Next, we have the cost of sale. Input a percentage that represents the anticipated costs associated with selling the property. Factor in expenses such as agent commissions, closing costs, and other transaction-related fees. For this deal, we'll use 5% of the property's sale price. Next is the exit cap rate assumption. This rate is used to estimate the property's resale value at the end of the holding period. Year 7 in this case. A lower cap rate results in a higher resale value, while a higher cap rate reduces it. The refinance cap rate is currently disabled. We'll revisit it during the refinancing step. At the beginning of this tutorial, we researched and set our entry cap rate at 5.76%, then used it to calculate a preliminary offer price. If you skip that part, now's a good time to go back and complete those steps. For reference, the entry cap rate is displayed in the header right here. There are a couple of approaches to estimating the exit cap rate. A conservative method is to increase the exit cap rate slightly above the entry cap rate to account for added risk over time. One common rule of thumb is to add 10 basis points, 0.1%, for each year of the hold period. For example, a 7-year hold would add 0.7%. To apply this automatically, click the lower plus 0.1% per year button. SpeedAlyzer automatically increased our entry cap rate by 0.7%, resulting in an exit cap rate of 6.46%. This method is ideal for reflecting gradual risk increases over a longer hold period. Below the exit cap rate field, you'll find the calculated spread between the entry and exit cap rates. In this case, it shows our 0.7% increase we just applied. This quick reference indicator helps you ensure your spread remains realistic and aligned with market expectations. Another commonly used rule is to add a 1% to 2% premium to the entry cap rate to approximate the exit cap rate. This method offers a conservative buffer for market fluctuations, making it suitable for shorter hold periods or volatile markets. Which approach you use should take market changes and risk factors into account. We will use the 10 basis points rule for this deal. Next, let's continue to the refinancing section. In this section, you can quickly model refinancing scenarios. From cash-out refinancing to refinancing out of a shorter-term loan, such as a bridge loan or private money loan. Selecting 0 from the Refi year drop-down menu deactivates the model, indicated by a red square. To activate the model, select a refinance year greater than 0. To avoid conflicts, the maximum year in the drop-down is automatically capped to the year before the sale of the property. For example, our sale year is 7, so the max refinance year selection is capped at 6. Let's go ahead and select year 3 for the refinance year. The red square is now green, indicating the refinancing model is active in our analysis. All the grayed-out fields are now enabled. Additionally, 2 badges will appear in the cash flow summary section. The first indicates the year the refinance loan is originated, and the second shows when payments on the refinance loan begin. In this example, our refinance loan is originated and funded in year 3, with payments beginning in year 4. Once refinancing is activated, the Refi cap rate input becomes available. You can either enter a custom percentage or simply enter 0% to use the same value as the exit cap rate. In this case, 6.46%. By default, entering 0% links the Refi cap rate to the exit cap rate. This green bracket visually shows that connection. For this tutorial, we will use the 10 basis point rule and click the adjacent plus 0.1% per year button to apply it. Since we selected year 3 for the refinance, this adds 30 basis points to the entry cap rate of 5.76%, calculating a Refi cap rate of 6.06%. If we scroll down to our analytics section, we can view our exit and Refi cap rates being applied to estimate the property's market value in years 3 and 7. Next, we'll continue entering our refinancing inputs. Let's keep our LTV percentage at 65%. For interest rate, let's go with 5.5%. For amortization period, let's keep it at 25 years, and for closing costs, let's lower it to 1% of the loan amount. Above the refinancing model, you'll see a loan summary. This summary displays all the financing structures currently in place. In this case, we have our lender financing in first position and our refinancing in second position. At the top of the page, you'll find the returns ticker and the color-coded goal monitor on the right. Both update in real time as you adjust your refinance inputs, giving you instant feedback on key metrics. For example, let's change our LTV percentage from 65% to 80%. We triggered our low DSCR indicator. A quick look at the returns ticker shows that our DSCR range has dipped below our minimum target of 1.2, set at the beginning of this tutorial. I'll go ahead and change the LTV back to 65% to clear the issue. Below the refinancing model, we have another drop-down menu where you can activate an interest-only period for the refinance loan. Selecting 0 disables this option. To activate the model, select an interest-only period greater than 0. The max selectable interest-only year is automatically capped to match the refinance year we selected above. For example, if our refinance year is 3, the max interest-only period allowed is 3 years. Green double arrow icons will appear next to any drop-down menus with this capping in place. Let's go ahead and activate an interest-only period of 2 years for this refinance loan. Directly below your selection, you'll see the monthly interest-only payment for both the interest-only period and the period after it ends. Our returns ticker shows an IRR of 20.33%. Let's deactivate our IO period and see the impact. Our IRR drops to 20.05%. Not a huge benefit to returns, but if we're looking for lower payments in the first 2 years, we did see a payment drop of nearly $20,000 per month by modeling an interest-only period. Next to the goal monitor is the return of capital monitor, which tracks capital recovery from refinancing and from the sale of our property. If your objective includes recouping some or all of your invested capital through refinancing, this monitor lets you track those return percentages. In this example, 56.1% of your invested capital is recovered post-refinancing, with the remaining 43.9% returned from the property sale. To view the details of this scenario, click on the Show Scenarios button. From here, you can see the details of both the refinance and sale scenarios. You can view the market value at the time of refinancing, the existing loan payoff details, and capital recovery. For example, $2,489,370 of our invested capital is recovered from refinancing, while the remaining balance of $1,946,391 is returned at sale, fully recouping our $4.4 million investment. Plus, an additional profit of $7.1 million will be available for distribution. Next, let's go back to our refinance model and simulate an error we can analyze and troubleshoot. Let's see what happens if we try to refinance sooner. Let's change our refinance year from year 3 to year 1. SpeedAlyzer detected a Refi shortfall. Let's check our scenarios to see what happened. Our net proceeds after debt payoff was flagged as negative, indicating that the payoff amount for the first loan exceeds the available funds from the refinance loan. Let's go back and try to fix it. One change we can make is increasing our LTV from 65% to 70%. That resolved the issue, but our return of capital dropped from 56.1% to 2.5%. Let's go ahead and fix it by reverting our refinance year back to year 3 and our LTV back to 65%. Just like the Refi shortfall indicator we reviewed earlier, there is also a sales shortfall indicator. A sales shortfall occurs when the proceeds from the property sale aren't sufficient to cover the remaining loan balances. To simulate this condition, I'll dramatically increase the exit cap rate. A red square will appear in the goal monitor stack when this shortfall occurs. Let's cure the shortfall by resetting our exit cap rate. Lastly, the monthly refinance payment is displayed directly below the Refi IO period field. To view the full amortization schedule and finance metrics, click on the Amortization Schedules button in the ribbon menu. The amortization schedule for your refinance loan will appear on the right side of the page with your first position lender financing on the left. Next, we'll be using high-speed mode to project trends for both the economic vacancy and expense ratios over our 7-year hold period. We'll start with the T12 percentages that we previously entered on the deal inputs page. These serve as our baseline. Based on our business plan, we'll then define our stabilized targets for each ratio and decide which year we expect to reach those stabilized levels. For example, 8% by year 3 for economic vacancy and 38% by year 4 for expense ratio. Once we've done that, we'll input our assumptions to bridge the gap, filling in the years between the T12 rates and the stabilized rates with values that reflect our expected improvements over time. I'll demonstrate exactly how to do that in just a moment. Before we move on, note that AI Assist and Deep Mode are available for both economic vacancy and expense ratio modeling. I'll briefly introduce these tools, and full tutorial videos for each are linked in the description below. Let's begin projecting our economic vacancy rate using our high-speed analysis method. Economic vacancy includes 4 components: physical vacancy, concessions, loss to lease, and bad debt. Together, these factors represent the portion of potential rental income that is lost. When forecasting economic vacancy trends over the hold period, it's important to consider each of these components individually. Your projections should reflect both your business plan and external market conditions that could affect occupancy and rental performance. For example, upcoming renovations or construction, local rent trends, and overall market demand all play a role in shaping realistic economic vacancy assumptions. Let's input an example economic vacancy projection. We'll start with our T12 economic vacancy rate of 23.8%, which we established in Step 1 on the Deal Inputs page. Be sure that Step 1 is complete before continuing. This T12 value will serve as our starting point for projecting the vacancy trend over the hold period. Next, we need to determine the stabilized economic vacancy rate and the year we expect to achieve it, based on the property's business plan. In this example, we're targeting an 8% stabilized rate by the end of year 3. That means we'll need to forecast the economic vacancy rates for years 1 and 2, leading up to that point. Let's assume that rent increases and disruptive renovations will initially affect occupancy under our ownership. In year 1, we expect vacancies to spike, pushing the economic vacancy rate from 23.8% to 25.8%. In year 2, as renovations wrap up and newly updated units begin leasing, we anticipate a 10% improvement, reducing the rate to 15.8%. By year 3, with stabilization underway, we expect the rate to fall further to 8%. We'll hold this stabilized rate steady through years 4 and 5. The year 5 value will automatically carry forward through years 6 to 7. This forecast offers a strong baseline and can be adjusted as needed to test how different scenarios might impact overall returns. Above our economic vacancy row is the occupancy phase row, which displays a status label for each year's economic vacancy rate, such as start plan, lease up, or stabilized. SpeedAlyzer automatically detects the appropriate phase based on the rate you enter. You can also view the corresponding economic occupancy rate for each year in the first row of the cash flow summary section below. Let's take a quick look at AI Assist. Both the economic vacancy and expense ratio rows share the same AI Assist page. To access it, click the AI Assist buttons here or in the ribbon menu. With just a few inputs, this tool generates custom prompts. To generate economic and expense ratio projections, click the Prompt To button. You can paste the generated prompt into your preferred AI app, such as ChatGPT, Gemini, or Copilot, to return suggested ratio values for each year, along with explanations. You can then use those values to complete the relevant fields in SpeedAlyzer. SpeedAlyzer also features a deep mode for economic vacancy. Click the pencil button to open the economic vacancy estimator. Here, you can model individual components like vacancy loss, loss to lease, concessions and discounts, and bad debt for the first 5 years. With a single click, you can then transfer the total ratios directly to the Pro Forma's economic vacancy row. A video tutorial for this tool is linked in the description below. Let's move on to projecting our expense ratios. Similar to the economic vacancy rate projections above, we'll now forecast our expense ratio trend over our 7-year hold period. We'll begin with the seller's current expense ratio of 45.2%, established in Step 1 on the Deal Inputs page, and project forward from there. As mentioned earlier, you can also use the AI Assist or Deep Mode tools to help build your forecast. Let's walk through an example expense ratio trend based on our business plan for this property. We expect an initial increase in expenses due to an aggressive lease-up marketing campaign and disruptions during renovations. In year 1, we anticipate a slight rise in the expense ratio, from 45.2% to 47.2%. In year 2, as renovations wrap up and marketing costs decline, we project a 3% drop, bringing the ratio down to 44.2%. By year 3, as operations stabilize, we anticipate another decrease to 40%. We'll maintain the stabilized 40% rate in years 4 and 5, and carry it through years 6 and 7. This forecast serves as a solid benchmark, with room to adjust values as needed to analyze their influence on returns. SpeedAlyzer also includes a deep mode for building expense ratios. Click the pencil button to open the expense estimator. Here, you can lay out the T12 expenses and easily project future expenses. With a single click, you can transfer each year's expense ratios directly into the Pro Forma's expense ratio row. A video tutorial for this tool is linked in the description below. Next, let's project our Year 1 other income. In this example, the seller reported $85,100 in other income, which represents 5.3% of gross potential income, GPI. We'll maintain at least 5% of GPI and increase other income to $90,000 for Year 1. Since this income stream is already established, we'll start it in month 1. However, if the income were from a new source, you could select a start month anywhere from month 1 to 12, depending on when you expect to begin collecting it. Don't forget, we previously set the other income growth rate to 2.5%, and it will begin in Year 2. Next, let's project our ratio utility billing system income, also referred to as RUBS income. This input only applies to multifamily properties. If this were a self-storage deal, the RUBS input would be disabled. We'll set RUBS at $36 per unit per month. If the seller wasn't previously billing RUBS, we'll assume we're initiating the program and will begin collections in month 2. We also expect a 2% annual increase in RUBS revenue starting in Year 2 due to inflation. You can view your RUBS income for each year in the income section of the cash flow summary below. Next, let's take a look at the GPR Sensitivity Tool. This tool allows you to quickly adjust the property's gross potential rent to see how changes in rental income might impact its future financial performance. Make sure you've completed steps 1, 2, and 3 of the analysis, and that any seller financing or investor distributions have been modeled before using this tool. Let's see how a decrease in gross potential rent GPR affects our returns. Currently, our IRR in the returns ticker is 19.19%. Let's lower our starting GPR by 2% using the minus button. The IRR dropped to 18.16%, indicating there's some income flexibility in this deal. You can also observe the GPR row adjust over the holding period in the cash flow summary below. Keep in mind, you can also increase the starting GPR by using the plus button. When you're done, click the reset button to return to the original GPR values. Above the GPR Sensitivity Tool, you'll find the T12 to Y1 EGI gain monitor. This metric measures the percentage difference between the seller's T12 income and the projected first-year effective gross income, EGI, offering additional insights into the impact of income adjustments. In this example, our Year 1 EGI is 11.3% higher than the seller's reported T12 EGI. Below all the inputs, you'll find the Pro Forma projections and returns summary reflecting the performance assumptions we've just modeled above. Before reviewing this section, let's take a look at our working capital needs first. In SpeedAlyzer, working capital includes funds needed to cover any negative cash flows identified in the Pro Forma. If a shortfall is detected in any year, that amount will automatically appear in the recommended working capital field. Currently, there are no years showing negative cash flow. Let's create a scenario in Year 1 to demonstrate how this works. I'll spike the Year 1 expense ratio to 80%, which should trigger a negative cash flow. Notice that an alert has appeared on the left, stating that working capital is required. Let's scroll down to the working capital section. SpeedAlyzer has detected a negative cash flow of $171,926, shown in red and displayed in the recommended working capital field. To fund this shortfall, simply check the Fund Working Capital box. This amount will be added to the capital contribution, and a label will appear in the Year 1 capital contribution row to indicate that working capital has been included. This ensures the deal is properly funded and remains financially stable throughout the holding period. If we navigate back to the Deal Inputs page, we'll see the working capital amount reflected in the Deal Metrics section, included in the total project cost and increasing our initial cash investment. You can also enter a custom amount in the Override Working Capital field, as long as it exceeds the recommended amount. Also, leaving the Fund Working Capital checkbox selected puts the working capital function into auto-fund mode. Now let's revert to our original assumptions and cancel the working capital requirement. I'll return the Year 1 expense ratio to 47.2%, which resets the recommended working capital to $0. Finally, if you want to include a working capital buffer, simply input a custom amount, like $50,000, and as long as the checkbox remains checked, SpeedAlyzer will add it to the deal. Before we end this tutorial, let's briefly explore the rest of the page. The cash flow summary is included in the Pro Forma projections table. This table offers a comprehensive overview of anticipated financial performance for the analyzed investment over the holding period. Through detailed forecasts of income, expenses, debt, and cash flows, investors gain valuable insights into future profitability and potential risks. It serves as a roadmap for decision-making, enabling stakeholders to assess feasibility, efficiently manage financial resources, and optimize investment strategies. On the right, you have two buttons that toggle the color of negative values in the table between black and red, depending on your preference. Located below the cash flow summary, the property level returns summary table examines capital contributions, cash flow after financing, refinance proceeds, and sale proceeds to determine net cash flows. Essential metrics such as cash-on-cash returns, internal rate of return, IRR, average annual return, AAR, equity multiple, return on investment, ROI, and profit are calculated from these figures. This analysis offers investors crucial insights into investment performance, guiding decision-making effectively. Located below the return summary section of the Pro Forma analysis page, you will find a detailed year-by-year set of analytics, including market values at the time of refinancing or sale, loan payoff amounts, equity and debt metrics, expense ratios, break-even occupancy, rent per unit and per NRSF metrics, sale price per unit and per NRSF, as well as annual expenses per unit and annual cap rate percentages. These analytics are conveniently compiled for each year the property is held, providing a centralized reference point for quick assessment. You can also print a black and white copy of the Pro Forma or save it as a PDF from the ribbon menu above. Well, this wraps up the tutorial on our Pro Forma page of SpeedAlyzer. We trust that our streamlined entry process will accelerate your deal analysis. After all, minutes matter in real estate. Make informed decisions fast with SpeedAlyzer. To view more tutorials, visit our iHeartCRE YouTube channel and subscribe for further insights and updates.